This class is brought to you by Isaac Humanitarian Foundation. So, my name is Idehen, and I'm taking you accounting and the topic bank reconciliation statement. So, to start with, from our previous videos that we have uploaded, I think one of our colleagues are taking the topic on the cash book. Yeah, on the cash book. And then we are made to know that our cash book comprises the bank column and then the cash column. So under bank reconciliation statement, what we just need is the bank column of our cash book. We are not concerned with the cash column. So we need our bank column and compare it with the bank statement. So what is bank reconciliation statement? Bank reconciliation statement is just telling us how can we reconcile the differences between the cash book and our bank statement. That is the bank column of the cash book and our bank statement. Yeah, I say what differences? Sometimes there are some entries by the bookkeeper or the bank that may cause differences between the cash book and the bank column. Between the cash book and the bank statement. So what are those entries or transactions? I've listed some of them on the board. So I would say bank reconciliation statement is a statement that is prepared to reconcile the differences between the bank column of the cash book and the bank statement of a business organization. That's just a brief definition of bank reconciliation statement. So what are we going to be doing under this topic? We are going to prepare an adjusted cash book to make sure that the bank column of our cash book is in line with our bank statement. We adjust our cash book, and then again we prepare a bank reconciliation statement to make sure the balance of the cash book, that is the bank column, is the same thing for the balance in the bank statement. Okay. Let's say in January 1st, we are running a business from January 1st to 31st of the same month, January 1st to 31st. And then we are running a business in cash and credit. Fine. That is the basis in accounting. There are cash basis and what? On credit basis, or we call it accrual basis. So now, all the transactions that are done in cash will be recorded in the cash book. That is, all transactions that has to do with cash and bank are put in the cash book. And then again, all the transactions that we do with our bank and our customers do with our bank are transferred to the bank statement. They are transferred to the bank statement. So now we are not comparing all the transactions in the bank statement and then our bank transaction in the cash book. So we are comparing those two to make sure that they are in line with each other during that period of one month, that is from January to January 1st to January 31st. So what are those things that will cause differences is what we are looking at, and we want to make sure that everything is reconciled so that we can move on to the next month or to the next accounting period. So first we look at what unpresented checks. Unpresented checks are checks which has been issued by a business to what? To people, or to the creditors, or to our sellers. But those people that those checks are issued to, or the sellers, or the creditors have not presented a check to the bank for payment. So meaning that when we are issuing check, when we issue check, the check has been recorded in the cash book, because when we issue out, it means that cash is going out. Cash will be deducted from our bank account. So when we issue check, we are crediting cash book. We are crediting cash book with that amount. We are crediting cash book with that amount when we are issuing check. But in our bank statement, These are cash book. Cash book. That's the bank column. The bank column of our cash book. The bank column. We are crediting it with that amount on the check. But in our bank statement, no entry is what's appearing. There's no entry here because we are meant to debit our bank statement to show that we are issuing our check or money is being withdrawn from our bank account. So we are meant to debit it, but no entry has been what? Has been recorded. Why? Because the seller or the person to whom we issued the check to has not presented it to the bank for what? Payment. So why would this one cause a discrepancy between a cash book and bank statement? Is that the credit side will be what? Overcasted. The credit side of our cash book will be overcasted. So how can we correct this transaction? Is by what? Removing the said amount. Removing the amount that we have already credited in our cash book. How do we do that? We take it to our bank reconciliation statement. I'll show you how we do that when we are solving a question. So this one is for us to understand the concept behind what unpresented check. The check that has been issued out, but such people, the people they issued the check to, has not presented it for what? Payment. So there is no other entry for it in the bank statement. So that is why a discrepancy will occur between the cash book and our bank statement. Then the second one we talk about was uncredited checks. Uncredited checks. These are checks that has been received or collected from customers, maybe for payments, for goods that we sold, or from debtors. We have received check, but such check has not been credited. We have received the check, we have presented it to the bank. So the bank will credit our what? Account with them. So the bank ought to credit our account. Now this one is unpresented check. We receive the check. Since we are receiving, our bank column in the cash book will be debited because we are receiving based on the principle of double entry. Debit was the receiving account and credit the giving account. From here, we have to debit our bank column with such amount. Then we credit what? The bank statement. That is left to the bank to do. So we have done our own part by debiting our cash book. Then we take the check to the bank for them to perform the transaction, the second leg of the transaction, which is to what? Credit the bank statement. But what will why do we not call it uncredited? It is uncredited because the bank has not credited our account to the tune of that amount. So the bank has not recorded the second leg of the transaction. So what will be the effect of this? The effect of this is that what? Our cash book, the debit side of our cash book will be what? Overcasted by such amount. Why? What was the reason the bank were not able to credit our account? Maybe, okay, our month end is 31st of January. So, but now we presented a check the same day, 31st of January, when they are preparing our bank statement. Because every month, or probably every week, depends on how the business wants it. The bank, we issue a bank statement to you. We send a bank statement to you, maybe through your email or whatsoever form, or through hard copies, or when you apply for it. So the bank will send the bank reconciliation and the bank statement to you, and for you to be able to cross-check with your cash book. So, but at the end of the month, we presented a check which we collected from our debtors. We have recorded the transaction, the first leg of the transaction. The next leg, the bank were not able to do anything on it because we presented it late. So since we presented it late, they would transfer the entry to the next month or to the next accounting period. So by so doing, no entry is here. No entry is here. But we have already debited that amount in our cash book. that we have received it, but the bank has not reckoned with it. So, meaning that what our our cash book is what overcasted by that amount. So what we have to do to correct this, we have to remove this same amount as well to make sure our cash book is in line with what the bank statement. We cannot make our bank statement to be in line with our cash book. Why? Because the bank has already issued the bank statement to us. So we are meant to adjust our cash book. That's the reason we prepare what? Adjusted cash book. We cannot adjust the bank statement. So we are meant to adjust our cash book to be in line with the bank statement. So that's what we do. That's what uncredited check. Then let's look at next. The bank charges. The bank charges. I think I'll throw more light on the dishonour check. The bank charges. Now, it is normal, it is usual for a business to be running a current account with a bank. So whenever you are running a current account, the bank has some charging for some amount or some rates. They will charge you at the end of the month or at the end of the year. So at the end of the month, the bank will not notify you that this is what we are charging you. We are charging you 200 naira for all the transactions we carried out on your behalf. No. They will only merely debit your bank statement. You maybe at the end of the month during the following month, you are receiving the alert that okay, the bank charges for the previous month is also amount. Bank charges for the previous month is also amount. So, but you now look, you have not done any transaction in your cash book because you don't know the amount they are charging you. But the bank has already debited your account. So what do? You also have to come to your cash book and credit your bank column of the cash book to make sure that the second entry is intact. They've debited your bank statement, your bank account, then you have to credit your cash book, the bank column of your cash book, to make sure that entry is complete. Then your standing order, the same thing. Standing order is just an order they give to the bank to pay on your behalf a certain sum of money to a specified person at a specified date. Standing order is an order given to the bank. I am the one giving an order to the bank to pay so certain amount of money to a certain person at a specific date. All the three must be intact. You are giving an order to the bank to pay certain sum of money. What is the amount? Let us assume it's 5,000. I'm giving an order to the bank to pay 5,000 to someone at a certain date to a certain person. Who is the person? Tolu. At a certain date. What is the date? 31st of every month. 31st of every month. 31st of every month. 31st of every month. So the standing order must comprise these three details. The amount you are ordering the bank to pay on your behalf, the person to which they should pay to, and at what date, and at what interval. So let's say 5,000, pay total 5,000 as the 31st of every month. That's what the standing order is talking about. So standing order that which we have given to the bank will carry that out at the end of every month, 5,000 naira. But we may not be aware that we have given the bank a standing order. Or yes, we are aware, but it just catch up with us unnoticed. So the bank debited our account with 5,000 at the end of the month. But we have not done anything in our cash book. This also will affect our cash book. This also will affect our cash book. Why? Because we are not putting any entry here, but our bank statement is debited with 5,000 naira. So that is that. I move to what? Credit transfer. Credit transfer is just something what? Where a customer transfer directly to your bank account without notifying you. That's what credit transfer. A customer transfers your bank account without notifying you. Where at the end of the month, when your statement is sent to you, you find it on the bank statement that okay, so person has paid so amount to me, but I didn't know. So now that amount will what? Cause a discrepancy between your what? Your cash book and your what? Your bank statement. It causes a discrepancy between your cash book and your bank statement. Then dividend, the same way with credit transfer. Dividend, maybe you invested in some other companies, or you invested in any other business, which at the end of the year they are paying you dividends. So dividend is just the amount received on what? Investment. Amount received on investment. That's after paying your tax on it. The company will have deducted your tax before they what? Remit the money to you. So dividend is what transferred to your account at the end of the year, or probably at the end of the month, whichever. So, but you are not aware as well. The same thing with credit transfer, you are not aware. The money is transferred to your account, how much? Whatsoever their money is, dividend, credit, to be a credit to your bank account. But in your cash book, you are meant to debit. But we are not aware of that transaction, but we have not done that. Since we have not done that, this will also what? Cause a discrepancy between your cash book and your what? Bank statement. We move on to what? Direct debit. Direct debit, this is somehow close to what? A standing order, but it is different. But here, you are only giving a creditor. Giving the creditor to initiate a debit into your bank account whenever such amount is due. To initiate a debit into your bank account whenever such amount is due. So you are not that you are ordering the bank to pay a sum of money to so person. No, that's a standing order. But in a direct debit, you are giving the creditor the right to what? Make or initiate a debit transaction in your bank account whenever such money is due. So that is a direct debit. So whenever such person does that, what will happen? Your bank statement will be what? Debited. Your bank statement will be debited, but whereas your cash book ought to be what? Credited, but we didn't do that, not until we found it on our bank statement. So as a result, that will also what? Affect the agreement between what? Our cash book and our bank statement. Because no other entry was recorded in the cash book, only in the bank statement. Then our bank errors. Yes, the bank is liable to error. Nobody is above mistake. But now our bank also can make error. Error of what? Overcasting or what? Error of commission. So what type of error the bank makes? Commission, that is mistaking one person for another. Mistaking one person for another. Maybe they wanted to credit our account. Our business is Yemi and Co. So they wanted to credit our account with some certain amount. But instead, we now credited Yomi and Co. So we credited Yomi and Co. instead of crediting our own account, Yemi and Co. So such errors can occur in our bank statement. It is possible. So any error that occurs in your bank statement, we call it bank errors, because the error from the bank. So in this type of situation now, instead of crediting our own account, we credited this. But we have already debited our cash book with that money they ought to credit us in the bank statement. We have debited our cash book. So, but instead of crediting us, they credited another person. So what will happen? Our cash book will be what? Overcasted. The debit side of the cash book will be overcasted. Because when we are comparing the debit side to the credit side of the bank statements, there will be what? Discrepancy as a result of this amount that was not what credited into our account. So what will happen here, we discussed that in our one example we are going to take. Then the last is what? Undercasting or overcasting of the cash book. Undercasting means what? Recording a lower amount. Recording a lower amount in the cash book. While overcasting means recording a higher amount in the what? Cash book. So we are talking about undercasting and overcasting. Undercasting, we wanted to record an amount of 300 naira as a debit in our cash book, but whereas we recorded 250. We recorded 250. So this amount, the debit side has what? Undercasted by how much? 50 naira. Because we need 50 naira to make it up to the actual amount of 300. So our debit side has been undercasted by 50 naira. So what are we going to do here now? We are going to add the amount back to the what? Cash book. That's when we are performing what? Reconciliation. But when it comes to overcasting, maybe we are meant to deduct. In our cash book, we are meant to deduct 500 naira. We are meant to pay 500 naira out, the actual amount. But instead, the bookkeeper wrote 600 naira. So there's a difference of 100 naira. That difference is what? Overcast. Because the amount we are meant to record was 500, but in error, the recorded was 600 naira. So the difference of 100 naira is what? Overcast. What do we have to do? We have to reduce the amount that we have credited. How do we reduce it? We debit the cash book. So that's all we do under what? Bank reconciliation statement. So now to come back to the dishonor check. Dishonor check can be in two forms: when you are issuing out check and when you are receiving check. So it depends. So, but when you are receiving check from debtors or from customers, check you are receiving from customers, we are meant to debit our account. We are meant to debit our account. If we are debiting our account with that amount on the check that they have issued, then we take it to the bank for them to what? Credit our account, because the amount we are having in the bank account will have what? Increased. So what will happen? So after debiting our cash book, we have debited our cash book, but the bank, after taking it to the bank now noticed error. He said, fine, we cannot process this check for what? For credit. Why? Because of some certain what? Anomalies on the check. So what do we have to do? In our bank statement now, since there is no credit entry, so the debits we have already done has made our what? Our cash book to be what? Overcasted. The debit side of our cash book to be what? Overcasted. So by so doing, this will cause a discrepancy between the cash book and the what? Bank statement. So it causes a discrepancy between the cash book and the bank statement. So what do we have to do to this? We have to remove this amount from what? From the cash book. How we do that? We'll explain that when we are taking our examples. I think that is basically most of the items that will cause discrepancy between cash book and bank statement.